Good morning and welcome to Carr, and Ingram's 2021 year-end tax planning webinar. This morning we're going to cover different ways you can strategize, optimize, and maximize some year-end planning tools specific to individuals. So in this webinar, we're going to cover topics that you can think about and discuss with your CRI advisor on things you may want to do before the end of the year or to get ready for the 2021 filing season in early 22. So before we go any further, let's go ahead and cover some housekeeping items. First, we do offer CPE credit, continuing professional education credits, if you do need those. We will offer one credit. You have to be in attendance for at least 50 minutes. You should be logged in under your own unique link. That's how we track how long you've been in attendance. You have to answer at least 80% of the polling questions. And if you meet all those criteria, you should receive your CPE certificate within the next 7 days. So watch your inbox, and if you don't have it after that 7-day period, feel free to email our marketing team at marketing@cricpa.com. Additionally, if you check the chat function of the Zoom platform, it'll have a link to the slide presentation. So feel free, if you want your own copy of these slides to go through, you can download those now. Additionally, you should receive another email within the next day or so, which will also have a copy of the slides as well as a copy of this recording. So if there's any part that you wanted to go back and review and cover again, you should have that in your inbox in the next day or so. If there are any questions that arise during the webinar, feel free to use the questions and answer portion of the Zoom platform. We will try and tackle as many of those questions as we can during the course of the webinar. So feel free and enter those questions as they arise. First, before we go any further, let's go ahead and cover the presenters of today. First, let me introduce myself. I am Chris Hoffman. I am the tax service line leader of Carr, and Ingram. And I also sit in the Nashville, Tennessee office. I got my master's degree from the University of Tennessee, and I enjoy watching my hometown teams, the Tennessee Titans and the Nashville Predators, as well as my Vols, of course. Each year, I do take an annual trip to Hilton Head and enjoy the beach out there. And at home, I have 2 Boston Terriers. So presenting today is Amy Hightower. She's a partner in our Tifton, Georgia office. She enjoys hiking in national parks, running and training for marathons. She likes traveling to Hawaii, and her animals at home are a little bit bigger than mine. She has a Great Dane, a pit bull, and also some cats. Also presenting today is Caitlin Wansock. She is a senior in our Tallahassee, Florida office. She got her master's degree from Florida State University, and she likes watching sports as well, specifically the Jacksonville Jaguars and her Seminoles. In her free time, she likes drawing and painting, and she had an exciting event this year by buying her first house. So with that, we'll go ahead and get things started, and I will hand it off to Caitlin, who's going to cover some updates to the brackets and deductions.
Fantastic. Thank you, Chris. Yes, our first section will cover some updates to the tax brackets and deductions for 2021. It'll be pretty easy, just some slight changes from 2020. So let's hop into it. First, we have the 2021 tax rates. The actual rates are the same as the 2020 year, but with every year, we have the tax brackets or the income levels that have been adjusted slightly for inflation. We have the brackets on this slide for the single and the married filing joint. And this, just to give an example of the US tax system, you're taxed progressively. So when your income increases to the next bracket, each next dollar of income is taxed at a higher rate. So if you're in the 10% bracket, your first 9,950 are taxed at the 10% rate. If any dollar above that will keep getting taxed at the next highest rate, so the next $30,575 will be taxed at the 12% rate. So that's just a little example of how we're tax system works. This next slide, we have the brackets for the married filing separate and the head of household status. Same thing here for how that works. So we're just gonna keep on breezing through these. Next, we have the changes to the standard deduction, and just like the tax brackets increase, they also increase for inflation. The married filing joint status increases by about $300 this year for 2021, and all other statuses increase by about $150. Regardless of your income and other deductions, the standard deduction is allowed for all taxpayers, and an alternative here is to itemize your deductions. So if that works to your advantage and exceeds your standard deduction, you can also itemize. There are additional amounts for taxpayers over the age of 65 or are considered legally blind. They can take an additional $1,700 with their standard deduction, or if you are filing jointly, the taxpayer or their spouse, if they qualify for being legally blind or over the age of 65, it is a $1,350 increase to the standard deduction for one or both the taxpayer and their spouse. While normally considered for itemized deductions, we have charitable contributions that have been deductible as an above the line against your adjusted gross income up to $300. This is allowed per return in 2020, but for 2021, married filing joint taxpayers can take up to $600, which will be $300 per taxpayer and for the spouse. This is a good perk to be aware of, especially as we come close to the year end. So it can incentivize taxpayers to help contribute to qualified charities, and it's regardless of whether or not you can itemize. Health savings accounts, or HSAs, are an additional tax planning avenue, and they can work by allowing you to contribute pre-tax funds to pay for qualified medical expenses. For 2021, you can contribute up to $3,600 for self-only coverage or $7,200 for family coverage. HSAs are available for taxpayers with high deductible health plans, but the funds in an HSA roll over every year, and they can even earn interest. And any distributions that are used for qualified unreimbursed medical expenses can be treated as non-taxable. So not only do you receive a tax break for contributing to HSA funds, but you can maximize your contribution early in the year, accrue tax-free interest, and also be able to use these funds later for qualified medical expenses. On the topic of medical expenses, we're going to dive in a little bit for itemized deductions. Again, just as a reminder, itemizing is an alternative to the standard deduction, and one of the areas here is medical expenses. All medical expenses must exceed 10% of your adjusted gross income, or your AGI, to claim as an itemized deduction. And medical mileage can be considered at 16 cents per mile for 2021. The total of these expenses must exceed 10% of your adjusted gross income in order to count towards your itemized deduction. So one thing you can do as you are planning for your 2021 year or even going into 2022 is to plan any non-urgent medical procedures in years where you have lower income, or being able to bunch these into one year along with other items that we'll talk about. And that can help you just benefit more from itemizing. Additionally, taxes and mortgage interest can count towards your itemized deductions. There's no real changes here for 2021, but I do want to remind you of some current limitations in place through 2025. For taxes, this includes property taxes, state and local taxes, as well as general sales tax. These are subject to a combined limit of $10,000. And it can create some planning needs when it comes to bunching property taxes and other taxes in order to get as close to that $10,000 limit without going over it, or at least getting as close as possible to maximize your benefit. And that can work again by bunching it and possibly alternating between the standard deduction and itemizing year to year. Rental properties and business activities do not have this limitation on taxes paid. So anything in the ordinary course of those activities do not fall into this limitation. Mortgage interest is also allowed for itemizing for your primary and your secondary homes, but any debt incurred after December 15th of 2017 is limited to interest on home acquisition indebtedness and with a principal balance of $750,000 or less. Exceeding this amount can limit your interest deduction, and any debt that was incurred prior to December 15th, 2017 is limited based on a $1 million principal balance. Home equity line interest is not deductible unless those funds were used to improve the property, securing it, such as renovating or expanding the property. Additionally, miscellaneous deductions, which are those items that are subject to the 2% AGI limitation, these are suspended at the federal level still through 2025. This might include items such as unreimbursed employee expenses, investment expenses, estate planning, and tax preparation fees. It is important to note, especially coming out of COVID, that if you are an employee receiving a W-2 from your employer, the cost of working from home or any unreimbursed expenses are not considered deductible. They fall into this 2% category, which is still suspended at the federal level. But if you're self-employed, you are able to claim these items, and including home offices when it comes to your business activities. Miscellaneous deductions can vary at the state level, so just be aware of the current rules for this. We're going to spend a moment on charitable contributions. There are some additional limitations to consider here. In general, for 2021, any cash or cash equivalent contributions made are limited to 100% of your adjusted gross income. This is expected to return to the 60% limit for 2022. But just to be aware that you are able to contribute technically up to 100% of your adjusted gross income. Non-cash contributions, such as clothing and household goods, are able to be deducted up to 50% of your adjusted gross income. Capital gain property, which we'll talk about in a little bit, such as appreciated stock or real estate, is limited to 30% of your AGI, and cash contributions to donor advised funds, private foundations, and supporting organizations is limited to 60% of your AGI. Anything that exceeds these limits can be carried forward for up to 5 years, so it does allow for some planning considerations. To talk about those strategies, we'll talk about maximizing your charitable deductions and how alternating years for your donation to receive a larger deduction in 1 year and possibly itemized, along with kind of the idea of bunching your other expenses that are relevant for itemizing your deductions. You can do this where you alternate standard deduction versus itemizing your deductions each year. Donor advised funds can be useful in these years, especially if you have substantial income or if you're considering making a significant charitable contribution, but you're not sure which qualified charities you want the funds directed towards. Donor advised funds can be set up so you can make a large contribution in 1 year, but you're able to decide where the funds ultimately go in subsequent years. It'll allow you to get the tax advantage in that 1 year when you actually make the contributions of the funds. Qualified charitable donations from an IRA can allow you to take up to $100,000 of a distribution from a retirement account and donate it to a qualified charity. Ultimately, you're not taxed on this distribution up to the amount that you donate to a qualified charity, but it can satisfy required minimum distribution requirements, as well as provide alternatives to reduce your taxable income. QCDs do not count towards itemized deductions, and they're only considered once as a non-taxable distribution. Going back to a previous topic where I mentioned the appreciated stock, you can contribute appreciated stock to a qualified charity and potentially avoid capital gain taxes by giving you a charitable deduction in the amount of the fair market value. And that'll count towards your itemized deductions and not something that you will have to pay additional tax on. And I believe that'll bring us to our first poll question.
Okay, thanks, Caitlin. First polling question. What is the threshold to claim medical expenses in 2021? Is it 7.5% of your AGI, 10% of your AGI, 10% of your taxable income, or is it none of the above? Give everyone a few moments to answer that polling question. And in the meantime, Caitlin, I have clients that frequently ask me if they give to someone's GoFundMe page, does that count as a charitable deduction? Have you ever encountered that question?
Yeah, I definitely do see that a lot because you do see those and you're like, hey, it's contribution, that should count. But for tax purposes, it must be a qualified charity. So those are 501c3s. And normally you'll receive a tax deduction statement that'll tell you that this is deductible for tax purposes. If you're just giving to a friend to help cover, maybe they have a surgery coming up, maybe their dog needs surgery, anything that goes through GoFundMe is generally not considered a qualified charity. So it does not count towards that tax deduction.
Okay. Thanks, Caitlin. Let's look at those poll results now. It's like about 69% of the audience said 10% of AGI, 22% said 7.5% of AGI. Caitlin, I think the majority has it here.
Yes, they do. It is 10% for 2021. It was adjusted, so we'll go back to that 7.5% for 2022 based on the current rules that are in place, but 10% is what we're looking at for 2021.
Okay, I will pass it back to you, Caitlin, to cover some other unique considerations for 2021.
All right, awesome. Yes, we're going to talk about some unique items that are relevant to keep in mind when finishing up this year. So the first item that we have is the stimulus payments. So we saw a recovery rebate credit in 2020 with claiming any stimulus payments that you did not receive or any amounts that you didn't receive in full. This will still apply for 2021, and we'll be picking up the third payment, which was for $1,400, or if you're married filing joint, $2,800 on your 2021 tax return. An additional $1,400 can be collected for each dependent under the age of 17. So depending on what your adjusted gross income is and other related limitations, you can potentially regain some portions of this credit that you might not have received in advance. The payments were based on 2019 or depending on when you filed your 2020 tax return. So the credit can pick up any portion that might have been excluded based on your income levels during those years, as well as any changes on your tax return, such as having another child during 2021. These are not taxable income, and you do not need to repay any portion of your income or any portion of this credit if you received it in advance and your income might have phased you out for 2021. It's just important to keep in mind. As mentioned earlier, the above the line charitable deductions is allowed for 2021. This is $300 per taxpayer. So if you're filing single, this is $300. If you're filing jointly, this is up to $600. This is regardless of whether or not you are taking the standard deduction or if you are itemizing. It's just an opportunity to offset your adjusted gross income based on some cash you've donated to charities. Coronavirus-related distributions, or CRDs, ended as of December 31st, 2020, but the 3-year period to repay, as well as the tax recognition over a 3-year period, will continue through 2021. So we're going to talk about this a little bit later in the presentation, but that's something to be aware of for 2021 changes. Similar to 2020, we have some eligible refundable sick and family leave credit for self-employed individuals. This is something that can be claimed on the 2021 tax return and something that relates to any leave taken between April 1st and September 30th of 2021 for situations that an individual would have otherwise been able to receive paid leave under FMLA if they were an employee of an employer. This is just a credit that can work to your benefit if you are self-employed. Payroll tax deferral from 2020 under the CARES Act will have the repayment for the employee portion of payroll taxes deferred during the 2020 year. It'll be repaid during this 2021 year. So most of the time, this will just be withheld automatically from your pay. But for self-employed individuals, 50% of the employer portion, because self-employment tax is captured on your personal tax returns, 50% of the employer portion will be repaid by December 31st of 2021. The remaining half will be captured before the end of the 2022 year. So just be aware of these cash flow considerations throughout the year and how it might impact your 2021 and 2022 filing. Another item that has been a really hot topic are the advanced payments of the child tax credit, beginning from July 2021 and through the end of this year. It'll be a major consideration, especially if you depend on the refunds or the tax credits and the benefits that you might be receiving from the child tax credit for cash flow purposes. The advanced payments are up to $3,000 or $250 monthly per qualifying dependent 17 and under as of December 31st, 2021. And this is up to $3,600 or $300 monthly for each qualifying dependent under the age of 6 on December 31st. These payments are up to 1/2 of the total credit starting in July and going through December of this year. And there are certain income limitations that may phase you out of the expanded portion of this credit, which might add an additional $1,000 or $1,600 depending on the age of the dependent. But it does allow for higher income brackets to receive these advanced payments. However, they might be phased out of that expanded portion. This is just a visualization showing the dates the IRS requested changes to be made for these advanced payments. For the most part, most of them have indeed passed, but it is important to note that you can still update any changes for dependents or filing status before November 29th to be reflected in the December payments. And that can help you settle up or catch up to what the advanced payment should have been before we get into the actual filing season for 2021. It's also important to note that low-income families can sign up for payments before November 15th to receive appropriate advanced child tax credits for December. So just be aware of these final deadlines before the year end. Some additional notes on this advanced child tax credit. Payments are not taxable. They're just half of the credit that you would otherwise receive on your tax return. Any remaining portion of this credit that you either did not receive in advance or any adjustments that need to be made will be captured on your 2021 tax return for this coming filing season. This includes any changes in your dependents as well as your income levels and how that might impact your payments. Many taxpayers do not realize that they have a dependency on this tax credit. It can really help with getting a refund on your tax return. So it is important to consider that up to 50% of this credit might have already been paid out to you in advance, or that you might have some adjustments to repay or recapture on your actual tax return. So it can create some planning needs going into this filing season and might also offer some explanations for why your refund appears lower or maybe your amount due appears higher compared to other years. There were no significant changes for PPP loans going into 2021. For the most part, the funding did end as of May 21st or May 2021, and there's no indication that it will be returning for 2022. But it is important to note that if you had any loans forgiven in 2021, they are treated as tax-exempt income for federal purposes, and any expenses paid with PPP loan proceeds are considered deductible on your tax return. And that goes whether or not your loan was forgiven or if you still owe it for any reason. And it is also important to note that some states may recognize forgiveness as taxable income. That's more of a business item, but just wanted to point it out so that we're all aware of these implications. And that, I believe, brings us to our next polling question.
Okay, thanks, Caitlin. Polling question 2. How much of an above-the-line charitable deduction is allowed for 2021? Is it $300 for single or married filing separate or head of household? Is it $600 for married filing jointly? Is it all of the above or none of the above? Give everyone a few moments to respond. In the meantime, Caitlin, we have quite a few questions coming in. One of them is asking about sales tax. Can individuals still deduct sales tax if they itemize?
Yes, sales tax and any large purchases that you might have had, such as a car that you paid large amounts of sales tax on, can still be gathered for your itemized deductions. So they do fall into that $10,000 limitation for tax deductions on your itemized deductions list. So just be aware that you cannot exceed that $10,000. So the sales tax will get lumped together with any other state or local taxes you might pay, as well as property taxes to get to that $10,000 threshold.
Right. Yeah. Individuals still have the option of taking either sales tax or income tax plus property tax. But as you mentioned, Caitlin, a lot of people get capped at that $10,000. Let's look at the results from the polling question. 78% of the audience say all of the above. I think that's what we're looking for there, Caitlin.
That's exactly what we're looking for. That deduction is $300 for single, married filing separate and head of household, and $600 for married filing jointly. So all of the above is the right answer there.
Okay, great. Now we'll pass it back to you, Caitlin, to cover some capital gains and losses ideas.
All right, we're going to go through some updates for 2021. For the most part, it's pretty similar to 2020. So again, we'll breeze through some of these items and just use some reminders for any beneficial areas. Here we have the capital gains tax rates for 2021, very similar to ordinary tax brackets. They are just adjusted slightly for inflation each year. I know some people find it strange, but there is a 0% tax rate if your income is in the lower range, and it can be up to 20% for a tax rate. And these rates all apply to your long-term capital gains, whereas short-term gains are captured with ordinary income. And depending on your adjusted gross income, there is an additional 3.8% net investment income tax. So this is something that includes all of your investment income from interest, dividends, and your short and long-term capital gains and losses that can be subject to this tax. Some additional areas to keep in mind: there is a difference between realized and unrealized gains and losses. Unrealized gains means that the assets are still held and have not yet been sold or otherwise disposed of. And until you actually finalize that transaction, there is no realized gain or loss. And this can also help determine the time frame of whether or not it is a short-term or a long-term gain or loss, and also assess whether or not these unrealized amounts can influence any other sources of income. So possibly we'll assess if there are any unrealized losses that might be beneficial to recognize sooner rather than later. The 0% tax bracket is available depending on your income. It can help you with planning for when to recognize certain gains or losses and certain tax positions based on what your income looks like for the year. And we do find it important to consider the year-end uncertainty with the stock market and how that might accelerate recognizing different financial positions and what might best influence or help your tax position. It's also important to keep in mind the wash sale rules for capital losses. You cannot sell a security at a loss to offset capital gains and immediately repurchase that asset, because even if it occurs unintentionally, these losses can ultimately be considered essentially non-deductible if you are selling and repurchasing too quickly. Net capital losses are limited to $3,000 per year or $1,500 if you're married filing separate. And this can help determine how much we'll be able to offset ordinary income in the current year. The excess can carry forward indefinitely, which can definitely help when it comes to future planning for large capital gains. Also important to note, principal residence sales, taxpayers can exclude up to $250,000 of a gain or $500,000 if they are married filing joint, as long as you meet certain requirements for your residency. At this moment, future rates are still unclear if there will be any changes, so we're going to continue to expect the current rules to stay in place. There are several planning opportunities when it comes to accelerating capital gains for 2021 or offsetting other gains that you might have for sources of income. And that can include selling off certain holdings to recognize more gains based on your current capital gains rate and income level. Likewise, if you have significant losses, it might be a good opportunity to sell appreciated assets to net with those losses being recognized. As mentioned earlier, charitable deductions can be considered here when it comes to donating appreciated stock and give you the opportunity to realize gains, but not actually have to recognize them for tax purposes. Some additional planning opportunities can include significant gains being reinvested into qualified opportunity zones, and also to receive more tax benefits from taxing capital gains at marginal rates rather than capital gain rates, in order to maximize your investment interest deductions on your tax return. Finally, like-kind exchanges can be an opportunity to defer capital gains by investing in a similar property. There are limitations with these exchanges, such as they are limited to being real property, or they must be an investment or income-producing property. There is also a timeline which you must meet in order to recognize these like-kind exchanges and allow you to defer the capital gains, which is really important to keep in mind. A lot of real estate investors do like to go this like-kind exchange route, but we do recommend working with a qualified intermediary and being aware of any upcoming tax law changes when planning to sell that property that you did receive. We're always monitoring those tax impacts and how to plan for them, but it is something to keep in mind if you choose to go this route. I believe that'll bring us to our next polling question.
Okay, thanks, Caitlin. Polling question 3. Which of the following is not a capital gains tax rate? Is it 0%, 10%, 15%, 20%, or all the above capital gains tax rates? I'll give folks a few moments to respond to that polling question. Had a question came in. If someone who is over age 70 and a half makes a qualified charitable distribution from their IRA, can they also claim the $600 above the line deduction for that charitable contribution?
Yes, you can still make that as long as you and your spouse both make up to $300 of a separate charitable contribution, and it has to be cash or cash equivalent. So that includes credit cards, checks, or anything that is cash related and not a non-cash item like donating a t-shirt or something. But as long as the up to $600 is separate from what came out of your IRA and was contributed as a QCD, you can take that $600 deduction.
Great, thanks, Caitlin. Yeah, I think you mentioned it just has to be an additional contribution. You can't double dip and count the same contribution twice. So let's look at those polling results now. Looks like we have a split. 45% of the audience say all the above are capital gains tax rates. 40% say 10% is not a capital gains tax rate. Caitlin, can you clarify that for folks?
Yes, so possibly a little bit of a sneaky question, but the right answer is 10%. The capital gains tax rates are 0, 15, and 20%. So 10% is not a capital gains tax rate. That is for other purposes. You will see that for your ordinary tax rates as well as for certain limitations, but it is not applicable for capital gains taxes.
Thanks, great, Caitlin. Now we are going to move on to retirement accounts. And for this, we're going to hand it off to Amy, who's going to cover this section for us.
Thanks, Caitlin and Chris. So let's move on to retirement accounts. These are a fundamental tool for managing taxable income. They offer a unique advantage with the ability to make post-year-end contributions count as a previous year tax deduction. Some taxpayers may hesitate to maximize their contributions into plans due to the potential penalties on early distributions. So some may feel like they're afraid to put the money away up front. They may need it later, but they may be subject to penalties to try to access those funds. But keep in mind that there are a host of exceptions to these penalties, including education, medical, home buyer, and loans. These are just to name a few. And these exceptions depend on the specific type of retirement account you have. So let's move forward and look at the plan limits for 2021. For 2021, you can see the 401k, 403b, 457 deferral limit. That's how much as an employee you can defer tax pre-tax into a retirement plan. It's $19,500. So that remains unchanged from the previous year, but it will increase slightly for 2022. Most of you are familiar with a 401k plan. 403b and 457 plans are very similar, but are typically found with governmental employers, such in the cases of 457, or school or tax exempt entities or 403b plans. So I'm just mentioning these to give you a couple of planning points if you have access to a 403b or 457. Note that while the deferral limit of $19,500 above is per taxpayer in a tax deferred plan, a taxpayer who has access to both a 457 plan and either a 403b or 401k plan can double that deferral limit for the tax year. An example may be a taxpayer working for a state university that has both a 457 plan and a 403b plan. That would allow that taxpayer to potentially make up the contributions of $39,000 for those that are under age 50. Another overlooked opportunity for those with a 403b plan is the ability to make catch-up contributions in certain situations when you have 15 years of service with the organization. This may result in the ability of a taxpayer to make catch-up contributions at a much younger age than the statutory age of 50, which is usually the normal age for most catch-up contributions, is the $6,500 amount you see on the slide. Now let's look at the IRA limits for 2021. These contribution limits for IRAs remain unchanged for 2021 and 2022 for just looking forward. However, for 2022, certain income threshold applicable to traditional and Roth contributions do increase slightly. Keep in mind, if you are not an active participant in an employer-sponsored retirement plan, there are no income limitations on your ability to contribute and deduct your contribution to a traditional IRA. An active participant is someone who is employed at any time during the year and is eligible to participate in a plan. Even if they elect not to make contributions, if they are eligible, they're considered an active participant, and they have income limitations that they must not exceed to make a contribution. One last item I want to look at on retirement contributions is related to the tax credit. Many of you may not know that there is retirement savings contribution credit. While the maximum credit is only $1,000 for single or married filing separate taxpayers and $2,000 for married filing joint taxpayers, you should keep the benefit in mind in years that you're able to manage your income within the levels listed on the slide. For those that make post-year-end decisions on IRA contributions, the credit can increase your effective tax savings on a potential deductible contribution that maybe you're looking at now to make. You're looking at in 2022 to make for the 2021 tax year. Note that this credit is available whether you're making it for a traditional or a Roth IRA, and it also is available for employee deferrals. So if you're an employee and you participate in a 401k plan. There are a few eligibility requirements related to the credit. You must be over 18 years old. You cannot be claimed as a dependent of someone else, and you cannot be a student. So just a reminder out there that this credit does exist. So let's look at a few strategies with your IRAs. The first strategy I want to talk about is the spousal IRAs. Spousal IRAs provide an opportunity to make contributions for non-working spouses who do not have the earned income that's required to make a contribution. Utilizing the spousal IRA rules, a taxpayer can borrow earned income from a spouse, allowing married taxpayers to potentially double their IRA contributions for a tax year. The second strategy is a backdoor Roth, which works around the income thresholds that apply in order to make Roth contributions. A backdoor Roth is simply a conversion of non-deductible contributions that have been made into a traditional IRA. This strategy will not work for everyone, but it is definitely worth investigating. However, know that as of last Thursday, restrictions and potential elimination of this strategy were added back into the Build Back Better plan that's currently being considered. Now, that's not law, but it is currently being considered. Also, talking about conversions, when we are dealing with favorable tax situations, Roth conversions should still be considered for pre-tax contributions, allowing the taxpayer to convert the account to post-tax retirement dollars. Favorable tax situations that would apply when you should potentially consider a Roth conversion, a Roth conversion would be when you have net operating losses that you can offset this additional income, years in which you are in the lower than normal tax brackets, and years when the market is down. So your Roth account, your traditional IRA account balance is depressed, therefore making the conversion less of taxable income. With any conversion, the general rule is that you should have available cash outside of your retirement funds to pay any related tax. And just a caution that conversions can no longer be reversed. So timing is critical if you're considering making a conversion of your traditional dollars into a Roth. The final recommendation relates to dependent children, as it is never too early to begin savings for retirement. The only requirement is that a child have earned income, and while there are no borrowing rules like in a spousal IRA, a child's earned income could come from a family-owned business or simply those cash summer jobs such as babysitting. So lastly, on retirement plans, let's look at some distribution items. While 2021 hasn't brought any significant changes to the distribution rules, I just wanted to remind everyone of several changes that occurred in 2020 as a result of the Secure Act. And these are the increase in the required minimum distribution age, new rules regarding a 10-year distribution period for inherited IRAs, and penalty-free withdrawals for up to $5,000 in the case of a birth or adoption of a child. The biggest difference for you to take away today for 2021 is to remember for those with the required minimum distributions that those are required in 2021. Those rules were waived in 2020, but they have not been waived for 2021. Let's move on to a few strategies regarding distributions. First, since we've been talking about required minimum distributions, Caitlin mentioned the beneficial strategy of charitable RMDs that allows you to exclude the item from income. And this is great when you're managing adjusted gross income for other purposes and when you're not itemizing, which provides the option for you to realize your RMD in a tax efficient manner. Another potential strategy when you're trying to maximize the use of lower brackets is taking more than just your RMD amount, so that you can realize the income in a lower than normal tax bracket. And this could also reduce your retirement account balance that could reduce future RMD distributions. If your goal is to minimize your RMD, talk with your investment advisor regarding investing part of your retirement account in a deferred income annuity, which can reduce your RMD requirements. Finally, if you're still working, you can delay your RMD from your current employer's plan, only your current employer's plan. But that plan may allow you to roll other monies into the plan, which then could overall reduce RMD requirements from other retirement balances you have. A reminder and a planning point regarding COVID distributions. Caitlin briefly mentioned those earlier. If you elected to spread your 2020 distribution over 3 years of taxable income, 2021 is the second year of tax reporting. However, you can still elect to repay the entire balance and amend your 2020 return and recoup any taxes that you paid on the distribution in that year. The 10-year distribution period that I mentioned in the previous slide for non-spousal inherited IRAs that was enacted in the Secure Act is a new reason to review your beneficiary designations. If you have not already recently done this, the 10-year rule does not apply to beneficiaries under 18, providing an opportunity for some to keep the tax deferral benefits longer with an inherited IRAs. And finally, just remember that if you are in need of immediate funds and you're looking at tapping into your retirement plans, some plans may allow for loans that are non-taxable when timely repaid, and that can be an alternative to a distribution. Chris, I think we now may have a polling question for our attendees.
Okay, thanks, Amy. Next polling question. Question 4, what is the maximum annual contribution to a Roth IRA for 2021? Is it 6,500? Is it 6,000 even? Is it 7,000? Or does it depend on your age? Give everyone a few moments to respond. And in the meantime, we had a question come in, Amy. If a student has a side business and he's not a dependent of anyone, could he form his own solo 401k based on that business income?
Absolutely. If the child has a business that has some earned income, a solo 401k is an excellent opportunity and a good choice.
Okay, thanks, Amy. Let's look at those poll results now. So 54% say depends on your age, 22% say 6,000, 15% of the audience say 6,500. Amy, can you clarify that for folks?
Absolutely. I think D is what we're looking for. It does depend on your age. The slides indicated that 6,000 is the current year contribution, but if you're over 50, you are allowed to catch up, which would allow you to make $7,000 in contributions.
Okay, thanks, Amy. And now Amy's going to cover a pretty hot topic for some people, and that's virtual currency.
Thanks, Chris. So the IRS first defined virtual currency in 2014, and the focus has just consistently been increasing over the last couple of years, including up until 2020. The IRS added a new question on the tax return, asking about your activity, your involvement, and any transactions you have related to virtual currency. The pyramid on the next slide shows, sort of the hierarchy of virtual currency. The terms digital, virtual, and cryptocurrency are used interchangeably, but as you can see from this hierarchy above, they are all forms of digital currency. The infrastructure bill, now awaiting the president's signature, contains new provisions regarding information reporting related to virtual currency transactions. This is all in an effort to increase compliance with virtual currency reporting. In other words, the IRS wants to increase third-party reporting of your virtual currency transactions, similar to reporting of your stock transactions. Now, while this is waiting Biden's signature, it will become law this year, but it will not become effective until transactions in 2023. So that means in 2024, virtual currency exchanges will be required to report 2023 transactions. So we do have a little bit of time here. But the issue is that many taxpayers do not realize that they are generating taxable transactions with their virtual currency wallets. The IRS treats virtual currency as property, and thus the general tax rules of property transactions apply. So let's look at a simple example here. John makes an initial investment in Bitcoin of $10, and 2 years later, John's Bitcoin value has grown to $5,000. John transfers his Bitcoin to a third party for the purchase of a boat. So does John have a taxable event here? In this example, the IRS treats John as having sold his Bitcoin for $5,000, realizing a $4,990 taxable gain. So yes, the IRS believes John has a taxable transaction and he sold the Bitcoin. Paying for services with crypto and receiving crypto as payment for services also generates taxable transactions. With virtual currency considered property by the IRS, many planning strategies related to property transactions, such as stocks, will apply in similar situations to virtual currencies. So again, gifting, donating, we'll get back to lending crypto in just a second, tax bracket management, and harvesting losses. These are things that you are typically thinking about with stock transactions. You should think about with your virtual currency wallet. Donating appreciated virtual currency is just similar to donating appreciated stock. Lending crypto is a little bit different. It's just that it's a little bit more unique opportunity, with virtual currency being more widely accepted as payments for goods and services. You could lend your crypto rather than converting it to dollars, allowing you to utilize the asset without realizing the gain that you would have if you converted it to dollars. So again, just treat your virtual currency as part of your stock portfolio when looking at loss harvesting and realizing gains efficiently in certain tax bracket, including the ever popular 0% capital gain bracket we talked about briefly. That's all I'm going to cover on virtual currency. It is becoming a hot topic, but I'm going to turn it over to Chris for another polling question.
Okay, thanks, Amy. Polling question 5. Which of the following are digital currency? Is it cryptocurrency, virtual currency, Bitcoin, or all the above? Give everyone a few moments to respond. And in the meantime, had a question come in, Amy, actually on your prior topic on COVID IRA distributions. If someone took a COVID distribution from their retirement account, can they opt to pay the whole amount back in 2021, or do they have to wait and pay some of it back in 21 and some in 22?
If they're going to pay the whole amount back, they can definitely go ahead and pay it all back, and then they would amend their 2020 return for any amount that they paid tax on in 2020, if they elected to pay any tax, if they did not realize they were going to pay it back up front.
Gotcha. Thanks, Amy, for clarifying. Let's look at those polling results now. 97% of the audience said all of the above. I think that's what we're looking for there, Amy.
That's exactly what I was looking for, Chris. So I think we got virtual currency, and then we can move on.
Okay, sounds good. Next topic that Amy will be covering is educational expenses.
Yes, thank you, Chris. So education planning can be quite complex. It's a fine balance, attempting to achieve the balance between tax-efficient strategies with non-tax strategies that impact economics, such as financial aid and student loans. So today we're going to, briefly highlight just the primary tax vehicles. We're not going to get into how these vehicles coincide with financial aid and student loans and things like that, but that is something that you always want to keep in mind. So let's look at some of the primary funding mechanisms. education savings accounts, qualified tuition plans, which some people use the word 529 when they're referring to these plans, and IRAs are the primary accounts used for education savings. While each of these accounts receive post-tax contributions, and when IRAs I'm specifically talking about Roth IRAs, check your state tax rules, as many states may provide tax incentives for contributions into these plans. So even though it's not deductible on the federal side for the contributions you make into the plan, there may be some state tax benefits. Qualified tuition plan accounts do offer an additional incentive above any kind of income and benefits, and that's offering unique estate and gift tax planning opportunities. A taxpayer can use the 5-year gift tax averaging rules, enabling them to contribute $75,000 upfront into a qualified tuition plan with no gift tax consequences. So if grandma or grandfather would like to make a $75,000 gift into a qualified tuition plan, they can make that gift up front in 1 year, and that is spread over 5 years for gift tax purposes. Now, our next chart will summarize the key differences between the education savings accounts and the qualified tuition plans. Know that each account has some separate limitations that may restrict the tax benefits, such as the mandatory distribution age of 30 that's in an education savings account, or the income limit that the education savings account has for making qualified contributions. An easy planning pointer for the income limits on an education savings account is to simply make a cash gift to a student or another eligible person who's below those income limits, and allow that person to make the contribution into the education savings account. And just as a small bonus tip, if you'll notice the last line of the slide, that funds from an education savings account can be used to purchase a computer for the family, and it's not just for the account beneficiary, versus comparing it to a qualified tuition plan's eligibility to purchase a computer. So let's move on and look at a few strategies with these accounts. First, as we noted earlier, education savings accounts have a mandatory distribution age of 30. So one technique, especially beneficial for families with multiple children, is to roll the older child's unused funds into a younger child's account, or change the beneficiaries to another family member that's qualified, therefore extending the tax-free growth of the balance and delaying the 30-year mandatory distribution age. And while qualified tuition plans do not have this mandatory distribution age, beneficiary changes are allowed in those plans also. So if a beneficiary's education has been paid for, you can consider changing beneficiaries to another eligible beneficiary to extend the tax deferral within the account. And while hopefully this doesn't happen too often, if a qualified tuition plan is underwater, you have the ability as the account owner to claim losses in the account on your tax return. And finally, allocation of expenditures is crucial when, especially when utilizing tax deferred vehicles, while also trying to take the benefit of tax credits related to education expenses. Speaking of tax credits, let's look at those credits briefly. The chart above summarizes the key differences between the American Opportunity Credit and the Lifetime Learning Credit. In most cases, the American Opportunity Credit is going to yield the highest benefit, but remember, this is limited to 4 years. So let's look at a couple of ways we can maximize the use of these two credits. First, keep in mind, is claiming the credit your best option? While the tuition and fees deduction expired in 2020, some expenditures that are eligible for the Lifetime Learning Credit in connection with work-related classes from community colleges may be an allowable business expense deduction. So maybe you should evaluate, can you take a deduction in your business, or is the credit better? Another strategy would be to voluntarily tax scholarship funds. While this may seem counterproductive, this strategy is designed to utilize the lower tax brackets of a dependent along with the parent's tax brackets. So a dependent, for example, with minimum other income, would choose to allocate scholarship funds to non-qualified education expenses, such as room and board, and that would cause the scholarship to be taxable for the dependent. In return, this frees up qualified expenses for the parents to use in claiming an education tax credit, such as the American Opportunity Tax Credit. A final strategy would involve a parents foregoing the dependency exemption of the student. While the parents pay the out-of-pocket education costs, the child is now eligible to take the credit. This strategy is especially beneficial for high-income taxpayers who lose the ability to claim the education credits. In this situation, the child would need to have some income to get the benefit of the tax credit. So the child would need some income, therefore generate some tax for the credit to offset. And while the rules do allow a student to claim the credit as long as no one claims them as a dependent, even if they were eligible to be claimed as a dependent, though they may still be subject to the kiddie tax. Chris, I think it's time for our final polling question.
That's right, Amy, thanks. Final polling question of the webinar. What is the maximum number of years that the American Opportunity Credit can be claimed for a student? Is it 2 years, 3 years, 4 years, 5 years, or is there no limit? Give everyone just a few moments to respond to that. Take one more question that's come in. Amy, you mentioned a Section 529 plan when talking about education planning. Question came in from the audience. Can you cover what a 529 plan is?
So a 529 plan is a tax-deferred plan. It's often sometimes referred as qualified tuition plans. So qualified tuition plans are typically state-sponsored plans. So a 529 plan may or may not be state-sponsored, but it's a plan that allows you to put funds in after tax dollars. Again, in this example, you could put the funds in up front, up to $75,000. You put the funds into the plan. The plan may invest the funds. The funds may be invested in the market, but it works sort of like an IRA that as long as the funds are pulled out and used for qualified education expenses, the earnings are not taxable. So you get tax deferred growth as long as the funds are used for qualified education expenses.
Thanks, Amy. Let's look at those poll results now. 67% of our audience say you can use the American Opportunity Credit for 4 years. I think that's what we're looking for there, Amy.
I think, Chris, that we still have everyone's attention. Absolutely. That's exactly what I was looking for.
Okay, great. We'll wrap up in the next couple of minutes here. Amy's going to quickly cover some current developments.
Thanks, Chris. So yeah, our last topic today is going to be just a brief, let's tell you where it stands regarding the Build Back Better Act. So, it's been a whirlwind of tax proposals. The Build Back Better Act started with Biden's Blue Book framework. That led to the House Ways and Means Committee bill in late September. And then currently we were navigating the October House Democratic bill, which changed just as recently as last week. So as of yesterday, the House is delaying the vote on the Build Back Better plan until at least the week of November the 15th. And this is to allow the Congressional Budget Office to give them time to score the economics of the plan. And so while there's been so many changes and versions, it's really hard to say what will and will not become law at this point. Just keep in mind the three, I mentioned we went through 3 versions earlier, and each of those 3 versions were significantly different. The most recent change, though, that I want to point out is that as of Thursday, the SALT, that's the state and local income tax deduction, was added back into the plan. So currently we are dealing with current tax law limits your state and local income tax deduction to $10,000. The plan as of Thursday is going to reinstate the SALT deduction of up to $80,000 through 2030, and then it will sunset again. Like-kind exchanges, as of now, there's nothing to limit or further limit like-kind exchanges in the plan. Tax rates overall, individual tax rates currently in the plan, individual tax rates are not set to go up except for surcharges for those making over $5 and $10 million. Another change that was made Thursday is adding back into the proposed package restrictions on mega retirement accounts. Again, we don't know what's going to be in the final package, but that has been added back as of last Thursday. And finally, one huge component that has caused concern for many when discussions started on the Build Back Better plan, and has had many scrambling is the immediate sunsetting of the current estate and gift tax exclusion. For 2021, this exclusion was $11.7 million. And the Ways and House Committee proposal that came out in September was going to set this to sunset immediately, bringing the exclusion back down to $6 million. Now it's currently not in the plan that was updated as of last week. But while this proposal is not currently in the final bill, I would note that these expanded limits are set to sunset anyway, with many other tax provisions in December of 2025. So if you've not already reviewed your estate plan, consider reviewing and determine how you can utilize these increased limits, as they are use it or lose it limits. One popular technique we've seen in the last 12 months as an idea is using a spousal lifetime access trust, which utilizes your gift tax limit to make a gift into a trust. This trust would benefit your spouse during their lifetime, but when written appropriately, bypasses their estate. So you're able to use your gift limits before it sunsets. We don't know yet when it sunsets, but we do know at this point that at the latest it'll sunset in 2025, these expanded limits. So that's what we know about the Build Back Better plan. And we're just all, checking the news daily to see what Congress is going to do here.
Absolutely, Amy. Oh, excuse me. Just going to reiterate Amy's point that we will continue monitoring the situation, monitoring Congress, what gets passed. The best way to stay in contact and get those updates is to connect with CRI on social media. So any of our social media platforms, if you go there and connect with CRI, you'll be able to get those updates as they occur. So I do encourage everyone on this webinar to connect with us so you can make sure that you stay informed of what may be coming up in the next few months or 2022. So on behalf of all presenters, myself, Amy, and Caitlin, we want to thank you for your time today and hope you have a wonderful rest of your day.